Listen up, folks. The market is walking on a tightrope, and you need to know which way it's leaning. The biggest story right now is the new US-China trade framework hammered out in London. After months of brutal tariffs that saw US duties on Chinese goods hit a staggering 145%, we finally have a temporary ceasefire. Don't get too excited. This isn't a peace treaty, it's a truce. The deal sets US tariffs at a cumulative 55%, while China will only levy 10% on American goods. That's a huge step back from the brink, but Commerce Secretary Howard Lutnick is calling that 55% rate fixed and unalterable. That tells me this fight is far from over, folks. It's a positive development, but it's fragile. The details of this truce are where the real game is being played. China has agreed to give the US full access to rare earths and magnets for 6 months. This is huge. These are the ingredients for everything from iPhones to fighter jets. In return, the US is easing some export controls on things like jet engines and ethane. But here's the tell: Washington is not budging on high-end AI chips. That's the crown jewel, and the US is keeping it locked down. This whole deal feels like a strategic pause, not a long-term solution. Remember, the 90-day tariff pause from back in May is set to expire soon, so both sides are just buying time before the next round of negotiations. This high-stakes drama has real-world consequences. The trade war has already taken a bite out of the economy. US GDP actually shrank by 0.3% in the first quarter of this year, the first decline since the dark days of early 2020. We also saw US imports from China plunge by over 20% in a single month. That's a massive disruption to supply chains. On the other hand, because of these tariffs, US customs receipts quadrupled to $23 billion in May alone. That's a ton of cash flowing into the Treasury's coffers, but it comes at the cost of higher prices and economic uncertainty for businesses and consumers. So what does this all mean for you, the investor? It means you have to be nimble. The market is breathing a sigh of relief, but it's a shallow breath. The World Bank just took an axe to its global growth forecast, cutting it down to 2.3% for 2025. They're pointing the finger directly at these higher tariffs and the lingering uncertainty. Companies like Zara's parent, Inditex, are already reporting weaker sales because consumers are getting nervous. The path forward is murky, and while a full-blown trade war has been averted for now, the risk hasn't disappeared. It's just been postponed. Stay diversified and keep some cash on the sidelines. When you look at the stock markets around the world, you're seeing a classic case of investor indecision. The US-China news is good, but it's not great. Asian markets were all over the place, some up, some down, as traders tried to figure out who the winners and losers are. In Europe, the mood was a bit more subdued, with stocks and US futures trading softer. Why? Because the framework is just that, a framework. There are no guarantees it will hold, and the big money players on Wall Street and in the City of London know that. They're not popping the champagne corks just yet, they're waiting for concrete signs of stability. One bright spot in this sea of caution is the United Kingdom. The FTSE 100 index is trading near its all-time highs. Now that's a bull you can ride. The optimism in London isn't just about the trade truce, it's being fueled by strong hopes that the Bank of England is going to cut interest rates soon. Lower rates are like rocket fuel for stocks, making it cheaper for companies to borrow and invest. This shows you how central bank policy can sometimes overpower a messy geopolitical backdrop. While the rest of the world is biting its nails over tariffs, UK investors are betting on a dose of monetary stimulus. Back in the US, the picture is more complicated. We've got a market that wants to run higher, but it keeps looking over its shoulder. We're heading into a busy period with crucial economic data on tap. We'll be watching the producer price index to see if inflation is cooling at the wholesale level, and retail sales numbers will give us a snapshot of the American consumer's health. Is the consumer still spending, or are they finally pulling back? The answer to that question will have a huge impact on corporate earnings for the next quarter. Every data point matters right now. The biggest event on the calendar, however, is the next Federal Reserve meeting. All eyes are on Chairman Powell. Will the Fed signal that rate cuts are coming, or will they stay hawkish, worried that inflation might flare up again? The May inflation report was encouraging, showing just a tiny 0.1% increase for the month, but the year-over-year rate is still at 2.4%. That's close to the Fed's target, but maybe not close enough. The uncertainty around the Fed's next move is creating a ceiling for the market, keeping the bulls from really taking charge. Alright, let's talk about where the smart money is flowing. Forget the noise and look at the bond market. The 10-year U.S. Treasury yield, which is the benchmark for everything, has been dancing around the 4.5% level. But here's the important part. Yields dipped right after that cool May inflation report came out. Remember, when bond yields go down, bond prices go up. This tells you that big institutional investors are getting more confident that inflation is under control, which means the Fed might just have the green light to cut rates later this year. The bond market is often smarter than the stock market, and right now, it's whispering that relief is on the way. This has some of the biggest players on Wall Street, like the pros at PIMCO, sounding a warning bell. They're looking at stock valuations and saying, "Whoa, these look expensive," especially when you compare them to the relative safety and decent yields you can get from high-quality bonds right now. Their advice is to consider shifting some money out of high-flying stocks and into the stability of the bond market. This is a defensive move. It's about protecting your capital while still earning a solid return. When a giant like PIMCO says it's time to tilt toward bonds, you need to listen up. Now for the wildcard cryptocurrency. Booyah! Bitcoin has been on an absolute tear, smashing through the $100,000 barrier and trading close to $110,000. What's lighting the fire? The same thing that's helping bonds, cooling inflation and the hope for lower interest rates. But there's more to it. We're seeing a massive wave of institutional adoption. Big corporations are starting to use crypto for their own treasury management. Even my buddy Anthony Scaramucci is out there calling for a $200,000 price target on Bitcoin. The big money is officially in the game, folks. And it's not just about Bitcoin. Other coins are catching fire too. Ethereum is holding strong around 2,800, with a ton of excitement building for the launch of spot Ether ETFs. Think about what the Bitcoin ETFs did for its price. We could see a similar surge for ETH. We're also seeing explosive moves in altcoins like Solana and Ripple, which have been rallying hard. Even meme coins like Floki have doubled from their lows after a big ad campaign. The crypto market is hot, but be warned, we've got about $3.3 billion in token unlocks coming this month, which could create some serious volatility. It's a high-risk, high-reward playground. You can't get a full picture of the market without looking at commodities. These are the raw materials that build and power our world, and their prices tell a story. Oil, the lifeblood of the global economy, just saw its price jump about 5% to $68 a barrel. This move wasn't about the US-China truce, it was a reaction to geopolitical jitters coming out of Iraq. This is a classic reminder that the oil market is incredibly sensitive to instability in the Middle East. Any sign of trouble in a major producing region can send prices soaring overnight, which can then feed back into inflation. It's a variable you always have to watch. Gold, on the other hand, is telling a different story. The barbarous relic, as some call it, saw a modest price increase. Why? Because as we discussed, bond yields dipped. There's an inverse relationship here. When yields on safe haven assets like US Treasuries fall, a non-yielding asset like gold becomes more attractive by comparison. Investors who are nervous about the economy or potential inflation often flock to gold for safety. The recent price action shows that while there's relief in the market, there's also a healthy dose of underlying fear driving investors towards safe havens. It's not a roaring bull market for gold, but it's a steady hum of caution. So what's the final takeaway? What's the bottom line? The overall market mood is one of cautious optimism. Think of it as a patient who has just been moved out of the ICU. They're stable, but they're not ready to run a marathon. The US-China trade truce has removed the biggest immediate threat, which is fantastic news. It's a win. But the underlying disease, the strategic competition between the world's two largest economies and the threat of tariffs, hasn't been cured. The high tariffs that remain in place are still a drag on global growth, and that's not going away. Your game plan should be clear. The market is hopeful, but it's also fragile. The biggest risks on the horizon are a breakdown in the trade talks or a surprisingly hawkish turn from the Federal Reserve. You need to stay informed and be ready to move. Watch the upcoming inflation data and listen carefully to what the central bankers say. There are pockets of strength like UK stocks in the red-hot crypto market, but don't get carried away. The smart money is staying diversified, holding some quality bonds for defense, and keeping some cash ready to deploy when the next big opportunity or the next big scare presents itself. Now go do your homework.